What is up, Resource Nation? I'm going to get right into it with our famous guest that's been on several times. He needs no introduction, and the reason I'm getting right into it because we have a lot to unpack, but also I want to tell you why these shows are so important. I spent a lot of time this week going back and looking at our shows between Barry and I, specifically one that's 2 years to the day old. And Barry, first of all, thanks for being with us yet again. We couldn't have timed it better. So much madness in the market today as Q2 starts in 2021.
Thanks for having me. It's always a pleasure to be with you, man.
So let me pick up my thought and then we'll get going. Guys, 2 years to the day, I pulled a show that Barry and I talked about, and then several others. And this is why having Barry on the show and him lending us so generously his time to help us kind of navigate these waters as realtors, as lending professionals is so important. Because 2 years ago to the day, you can go pull the show up. He talked about the market that we are heading into. So April 2019, okay? Now everybody that talks, and it's CNBC and Fox News, they have this benefit of hindsight of what we just lived through, and so they sound really, really smart. This is Barry's words, and you can go back and watch it for yourself 2 years ago to the day. I had to write this all down, Barry, so stick with me so I can give you some credit. There's a reason why you're a multi-winner of the Crystal Ball Award winner, but on that show, on the 150-minute mark, you accurately predicted the exact market we were heading into for 2019. Remember, this is April 2019, and for 2020. Everybody else, now remember, put yourself back into that mind frame. Like, what were we dealing with back in April 2019? There was a lot going on. This is pre-pandemic. Barry talked us through and coached us through what we were heading into. At the 7-minute mark, talked about the inverted yield curve and made some really good predictions, bold predictions, you might even say, on the 10-year on that show and several shows after that you nailed. 1, 2, 3, 4. I think it was 5 of them in a row. I went back and watched several shows for the last 2 years. At the 8-minute mark, unemployment rates and why it matters and what happens when they get low. Nailed it. 10-minute mark, said rates were going to drop. Remember, again, this is 2019, guys. Think back. Rates are going to drop and lead to what? A big refi opportunity. And the best part about that show is you were contrarian. He said, hey, don't go pay points. Don't go upfront MI. You actually probably want to take a higher rate, which is the contrarian part, because why? Even lower rates were coming. And dude, you obviously nailed that part. 12-minute mark. Again, everybody has hindsight now, is like, oh yeah, housing's going to boom. You said it 2 years ago. Hey guys, and we were talking recession. Everybody was talking recession back then. You said, hey, housing's going to boom. Obviously, here we are. Housing is booming. So, hey man, first of all, kudos to all that. And again, for the viewers, that's why it's so important to have Barry on the show.
Well, it's very kind of you. A couple of clarification points there. So take the higher rate in exchange for lower fees.
Sorry, yes.
We thought ask them, right? And then actually, no one was calling for this. I was the only one calling for a recession.
Right.
People were making fun of me. People were saying you're crazy. And we did have a recession. January 2020 was the recession period. And that was 2 months before the lockdowns and the shutdowns came. So we were headed that way. And that's kind of a good segue to where we think we're going right now.
Yeah, that's why, I reached out to you again. Thank you for your time. I'm like, man, Barry, we got so much going on right now. I loved your update today about Biden's tax credit. We got forbearance talk. We got people searching the internet saying, is the housing market going to crash? Right now, lenders are kind of getting uneasy as volume starts to slow and the pie shrinks. They're getting a little uneasy. We just saw a huge merger and acquisition with Caliber, one of the top 4 lenders in the nation. You got realtors going, man, Barry, help me out, man. I'm starting to lose hope. I'm trying to help all my clients here, and we're losing out on offers. So clients and home buyers are losing hope. I need to phone a friend and call my Barry and help us talk through some of this, man. So give us some insight. What are your thoughts? I know I threw a lot at you there about all of that.
Let's start with rates, and let's try and be concise here. So here's the bottom line. People are being kind of held into a false sense of security here. Rates come down. Oh, they're going to come down. The longer-term picture is good, but short-term, I want you to be really on guard. Here's the thing. We are about to, over the next couple of months, see inflation reports indicate inflation much higher. If you take a look at one of the main inflation reports, the Consumer Price Index, or CPI, and you want to look at what's called the core rate. Core rate strips out food and energy. And some people, because they don't understand it, joke and say, well, what do you mean? I need food and energy. Yes, you do. Yes, we all do. However, we look at the core rate because that's what the Fed looks at, because that's what they believe they can influence with monetary policy. If a tanker gets stuck in the Suez Canal, if you get a drought or a bumper crop because of great weather, the Fed, regardless of their power, they can't control that. So the core rate is elements they believe that with monetary policy they can influence. So therefore, when we look at the year-over-year rate, it's 1.6%. But that is broken down into monthly levels of inflation, which when you add them up, you get to 1.6%. Pretty tame. It's up from where it was just recently at 1.3. So a little bit of a move, but still okay. However, next month, mark my words, it's going to be over 2%. Month after, around 2.5%. Now, if you're quoting a rate today in the low threes with 1.6% inflation, when it's in the mid twos rate of inflation, you're not going to be in the low threes. You'll probably be in the mid to maybe 3.75, like 3.5, 3.75 seems logical to me. So what's our strategy? Hey, get off the fence. Stop being butthurt on your refinance, okay? and people will be like, well, wait a minute, I need a rate under 3. You don't need a rate under 3. You need to save money is what you need to do.
Yeah.
You need to either be smart, strategically pay off debt, accelerate payments on your mortgage, and save money that way. Or in its plain and simple terms, on a rate and term, okay, so you could have saved $300 a month. Is saving $250 so bad right now? Because even if you're right, and it takes a year, and I'll explain where rates are going, to get back down to those low rates, then you're going to be in a position where it's going to take you about 4 years to recover that 0.5%, that $50 a month. It's going to take about 4 years for that to happen because the incremental savings after a year from now would take another 3 years or so to catch up to what you could have started saving today. So please explain to them, stop being butthurt. Don't be psychologically married to a rate under 3. If you're saving money and it makes sense, do it because rates in the short term are going to go higher. Good news. In the fall, I see rates coming back down a little bit. I don't think they get to where we were, but eventually they very may well get there.
Can you talk about why the fall? Like, what's your thought process in the fall that would cause that to happen?
The stimulus is ephemeral. In other words, it's going to wear off. Yep. You know the analogy: give a man a fish, and he eats for a day.
Right.
Teach him how to fish. We're not teaching anybody to fish. We're giving them fish right now. Okay, we're giving them fish. They're putting it on the table. It's creating economic activity, but they're going to be hungry afterwards. There's no more fish coming. Maybe, right? Probably. So here's what's going to happen. Let's look historically. Last year, CARES Act 1 and 2 in March and April of 2020. $2.8 trillion, enormous sum of money. Right. The $2.8 trillion generated a lot of economic activity, blah, blah, blah. By October, it already wore off. Let's look at GDP for 2020. Gross domestic product was 4.3%, but in the fourth quarter, it was a meager 0.4 of that. It was all front loaded, all a result of the stimulus. Now, coincidentally, maybe we have also 2.8 trillion that has been done in stimulus recently. 900 billion in December, 1.9 trillion in March of 2021 equals another $2.8 trillion. If the playbook is the same, likely by the fourth quarter, you will see the effects of this peter out. You will see a slowdown in economic activity, lower inflationary pressures, and probably interest rates respond favorably. And then as we go into 2022 or 2023, we set up for recessionary-like conditions. Whether we textbook get there or not, I don't know, but there will be downward pressure on rates during this period of time. Because look, remember, what drives interest rates is inflation. What drives inflation is economic activity. So you slow down economic activity, especially with the level of debt. The debt isn't free. If a family that wants to purchase a car, if they use credit to do so, which most do, they immediately generate economic activity. The salesperson, the dealership, they'll make money and they spend it and, we get some economic activity. Then what happens? What's left? That family now is $1,000 a month for the next 5 years, less that they can generate economic activity with. So it initially causes a spurt, but then there's a drag. And that's what we're seeing. We're seeing same things we saw back in 2018 and 2019 when we thought there would be a recession in early 2020, is we are seeing 2022, 2023, perhaps whether we get again. Is it a textbook recession? I don't know. But enough of a slowdown to give us a big refinance opportunity. So similar to that show, the advice is the same. The advice is don't pay points, don't pay upfront MI, and don't look for the lowest rate. If you could get lower fees in exchange for a little bit higher rate, pick it. Because guess what? The seeds you are planting today, loans above 3% that you're closing, these are tomorrow's refinance candidates, and you will refinance them.
I love it, man. I feel like we're going to be watching this show back in 2022, kind of pointing back to a lot of this. You talked about what's going to happen moving forward with rates. Is there any hope for housing, man? I mean, it's on fire. Today you talked about Biden's tax credit, and I love the analogy of pouring gas on an already huge fire. Like, what are your thoughts on that? And is there any hope for housing, like for people to buy a house? It just seems impossible right now.
So let's talk about housing. So housing, if you can get in the game, and I know it's not easy, okay? Before you'd give a realtor a lead for a buyer, they'd be like, great, now it's like, oh, what am I going to do with this? So it's not easy. And certain parts of the country are more difficult, but that doesn't mean the housing market is not a great investment. Be careful. We have a tool in MBS Highway that helps you evaluate how much to bid over ask and how long it will take to recover that, so that you can more, in a more educated manner, make these important decisions. Because right now, a little over 40% of transactions are bid over asking price. That's a lot.
Yeah.
We want to make sure that we're evaluating this correctly. So there's also a lot of discouraged buyers because they look for a home they can't find. So what you have to do is show them what the opportunity is. So keep people in the game, help them make better decisions. And the housing market's going to remain really hot. Look, I always have talked about demographics. It's interesting to see now others have finally discovered it.
Right.
Talk about it for years, right? So what I'm talking about. So when we talk about birth rates from 33 years ago, which is the median age of a first-time home buyer today, when we look at that, it helped us correctly forecast the housing bubble. It helped us correctly forecast the housing turnaround. And now we are looking at the next 3 to 4 years, a huge influx, a spike of first-time home buyers coming into the market, because looking back 30, 31, 32, 33 years ago, birth rates had an enormous spike. The result is going to be more people coming into the marketplace, and a tight inventory environment is going to be made even tighter, which supply and demand prices will go up. Now, Brian, people will say, well, hold on a second. Prices go up a lot, that means it has to crash back down. No. Let's look at California. California is a beautiful example of what the United States is about to witness. In California, home prices for the last 60 years pretty much have gone up with pretty significant averages of appreciation. And people say, well, it's not affordable in California. So expensive, not affordable. Well, here's how it works. In the United States, the home ownership rate is about 67%. In California, it's about 55%. So what does this teach us? It teaches us that there is, if enough people, if 55% represents enough people where it overwhelms the inventory, well, then prices will keep going up. Look, let me give you an example. If you have 100 people, right? 100 people, and out of the 100 people, 55 of them want to buy a home, but there's only 45 homes for sale. That means prices have to go up. If there were 70 homes for sale, 55 would mean prices would go down. So now we've got 67% home ownership, prices going up all over, but they can continue to go up so long as the population, even at a reduced percentage of those who buy, at that reduced percentage, is it still more than the homes available? In 2007, there were 3.7 million homes for sale. Today, there is 1 million homes for sale. Oh, and it's dropping. So about 3 million less homes. In 2007, you had 116 million households. Today, you have 128 million. So there's 12 million more households and 3 million fewer homes for sale. Is there any wonder why home values are going up? So these are things that we have to think about. Look, if we just strip it to the basics of supply and demand,
Right.
Prices go up. If there's more demand than supply. If there's more supply than demand, prices go down. So strip it down to, don't listen to all these. They don't understand what they're talking about. And then, you know what the other argument is that we always hear every single day? By the way, CNBC dedicated a full day this week to crushing the housing market and dashing people's hopes. That's an awful message to send.
What do you think the why is behind that? Because I was watching that and people talked about it, and it's on Twitter and on Facebook. But what's the why for CNBC to do that?
Advertising dollars and the amygdala.
Just get eyes. It's provocative.
So as you know, a lot of years on TV myself.
Yeah.
A lot of years. So it's called the amygdala. The amygdala is in your brain, as a part of your brain, and it's your reaction to fear. When something causes fear, time literally slows down and it imprints on your brain. Why? Because nature wants you to recall bad events so that you can circumvent them in the future by recognizing the pattern and protecting yourself. So the media is very keenly aware of this, which is why you get all bad news in the media all the time. You never get, oh, things are great. It's always trying to scare you, because that will cause you to focus, and then you'll get more eyebrows, longer viewer times, more advertisers are shown and seen, and they can charge and command more for that. So it's all about money. It's not about teaching you or telling you something that's right. It's about making more money for that. So if we understand that, then we should be able to filter out the crap that's out there and understand that There's a few elements too, but a lot of it is that they just don't understand it. Like, for example, affordability. Affordability, they have no clue. Because why? Because you have to break it down further than just the surface. And then it involves understanding math. Let's face it, math is hard. It's not the forte of the media. So what we want to take a look at here is what you heard just a week ago when they said median home price up 16%, hourly earnings up 4%. Dan Olek says unsustainable. Adam Data says we are miles away from affordability. So these are important headlines for us to understand and unpack, because our customer hears is like, our realtor hears is like, let's break it down. First of all, you don't look at median home price. As we remember in math class, median just means half the sales above, half the sales below. Well, if there's no inventory on the lower end, then guess what? You're going to have more sales on the higher end. It's going to skew that higher. Now, admittedly, appreciation is robust. It's 10%. So somebody says, okay, 10% appreciation, 4% hourly earnings go up, unsustainable. No, you don't look at hourly earnings. I know everybody does, but you shouldn't, because hourly earnings, I can work more hours or less hours. You need to look at weekly earnings, because that's more representative of what you're actually making. That's up 7%. Now somebody might say, okay, Barry, the math doesn't work. 10% appreciation, only 7% earnings, unsustainable. You might want to write this down, what I'm about to tell you. A year ago, if you were going to go buy a house and the monthly payment were $1,000 for just principal and interest, $1,000, your income would be about $5,000 a month, roughly, okay? Now, you missed out on that because you listened to all the media talking heads say how bad the housing market was and how it was going to crash. Now, prices went up 10%. Interest rates are actually 0.25% cheaper as the last report today than they were a year ago, but let's say they're the same. That means that monthly payment would have gone up 10%, representative of the 10% price increase, right? So instead of $1,000 a month, it is now $1,100 a month today. So it's costing you $100 a month more. You might say, well, it's less affordable, but we're not contemplating the increase to your income. If your income were to go up that same $100 a month, so instead of $5,000 a month, $5,100, you would now offset the effects of the appreciation, and you would still be the same relative level of affordability. But a $100 increase in income, that's $5,000, it's not 10%, it's 2%. Yeah. And that's what the media does not understand. A 2% rise in income can handle and offset a 10% rise in price. You don't need a 10% rise in income. So incomes are going up at 7% now. You can easily handle a 10% rise, a 20% rise, so long as interest rates don't get too crazy. Now, again, this requires some math and some understanding. This is the seventh most affordable, as crazy as they are, seventh most affordable market on record.
Jeez. I'm sure people don't understand that, but I love the fact, and I've said this about you for years, probably for a decade now, like the most underrated, under talked about talent for you is like you can take the most complex things and make them relatable to the man on the street using the analogies. Go back to the 100 people and the amount of homes analogy that you talked about. Go back to the analogy you talked about with $1,000 a month and the increase of pay. I love it, man. This is why we have you on, because so many people, it's so easy to lose them with technicals and demographics, but you're helping us understand it from a granular level. And I agree, like, yes, I understand housing is expensive and affordability, but like the market's telling us that we don't have a problem. Back to your analogies, it's still on fire. There's still a huge demand. So yes, is it more expensive? Okay, but the market's, it's still sustainable. They're still making offers. There's still 40 offers on every home out there. So
if you can buy a home, and I know it's not easy and I don't want to be insensitive, if you can buy a home and if you can evaluate it so you don't really overpay, the question that people need to know is pretty simple. I don't know if they understand it, but we need to teach it to them. If you're going to bid over asking price, what you need to know is, based upon forecasted appreciation in that zip code, when in the future, how long will it take till the value of that home meets and then eclipses how much you're paying for it? So you know that you're overpaying, but how long am I going to be in this upside down state for? If it's 3-6 months, okay. If it's 3 or 6 years, you really need to think about that. And the tool that we have at MBSI was the only one of its kind. It will tell you exactly how long the forecast is for you to then get to a level of recoupment of the overpayment and how much money you'll make in the future, which really helps people make better decisions. You're truly an advisor, and that's the whole point of it. Ryan, I do want to say one other thing about the naysayers in the market. They point to forbearance. And forbearance is just very highly misunderstood, especially by the media. So forbearance doesn't mean that when forbearance is over, here's a bill, pay me now. It means that you take the amount. What is forbearance? You put your payments on pause. So I press the button that says pause my payments right there. At the end of it, the amount that was paused isn't forgiven, but it isn't immediately payable. And in fact, there will be no payments or any interest due on that. So it's just a bundle of money. It's like a second mortgage, rides along the first. You eventually pay it when you sell your home, when you refinance your home. But at that point in time, people have a ton of equity. It will be staggered, be able to absorb it. Shouldn't be a problem. Now, how about releasing the pause button and resuming the payments? That could be a burden. But remember, you qualified for this mortgage to begin with, so you should be able to resume payments. We know a ton. First of all, forbearance represents a small portion of the mortgage environment, housing. It represents an even smaller portion when you figure out there were a lot of people who, as you know, gamed the system because the CARE Act did not require you to have any type of verification that you need this, right? With no proof of hardship. People just gamed it. So you remove those. That makes it a much smaller number. Now, the majority of people got their jobs back. So they should have no problem resuming payments. But let's face it, there will be a small portion, very small portion, and we have to be sensitive to this. We feel for them that they've got their payments coming back, they haven't got their job back. But we know this about COVID. It affected renters by a margin of 4-1 over homeowners, maybe because those people are more in the service sector who really got hard hit. So we feel terrible for all of them. But it is a very small number of homeowners who now will have to resume payments who can't. Now, they may have other resources they could draw upon. And the difference between 2009 is that in 2009, 26% of homes were underwater, meaning they owed more than the value of the home. But there was the lack of desire. Today, people have equity, huge amounts of equity. Let me give you this statistic. If you go back to 2007, the loan to value on average was 67. Today, it's 32, meaning that before you had 33% equity, today you have 68% equity, a lot more to protect. So people will protect it. And if they can't, they're not going to just go to foreclosure. What are they going to do? Sell their home. Now, you can say, okay, that brings inventory to the market. Well, if I take a bucket of water in the desert and sprinkle a little water on the desert, it's not going to cause anything. It's going to be welcome to the marketplace. So that's what the impact of this would be. So it's not going to be that.
And then you analogy. You already kind of answered these, and I love it organically. Our conversation, and you already answered the two most relevant questions of the week, of the month, which are, is the housing market going to crash? And then the other one is, there's a wave of foreclosures. I'm sure you've seen those headlines. Wave of foreclosures coming because of forbearance. You've already kind of answered both of those. But let's do it one last time. Any last thoughts on that? Because I really want to arm realtors and lenders to go take your words and go, guys, this simply isn't true. Barry talked about it for the last 15 minutes. You don't have to worry about a housing crash, and there isn't a wave of foreclosures because of what Barry just said. Any final thoughts on those two things? Because it's the most important thing, I think, right now that we can talk about.
Yeah, I think we've covered them. Is that there's just, look, the bottom line is there's too much demand, not enough supply, and there's not enough of these loans in forbearance that are going to move the needle at all. If anything, it'll actually alleviate some of the pressure. Some people also say, okay, when the masks come off, well, then we're going to have rampant inflation. It's the opposite, if you think about it. But listen, have you tried to get an Uber lately? What's happened? Waiting times are longer, and the cost has gone up.
Yep.
Why? If you ask any Uber driver, they will tell you it's because the stimulus checks have put people in a position where they may be in a position to make more staying at home than working. When this stuff ends, you alleviate the supply chain because you now bring more people in, more availability, lower prices means lower inflation. On a grand scale, you take the masks off, you take supply chain issues and you alleviate them, which makes prices overall start to relax a little bit. Inflation goes away, interest rates improve. So it's something to look forward. And look, could we just say the last point on this bonehead move by government to try and, I mean, it really is a bonehead move to put out a fire with gasoline. We know the housing market's on fire. So what's their answer? Let's put more buyers in. I mean, if somebody only explained to them that economics is like supply and demand, if you think it's too hot, why do you want to add more demand? So look, it's a straw man argument. It sounds great for everybody. Who doesn't want to help the first-time home buyer? We all do. Raise our hand. First one to try. But to hurt the housing market and hurt the first-time home buyer, you see, if they would just open up a history book, it's not that distant. 10 years ago, 11 years ago, this was a horrible idea in 2009 and 2010. And that was an $8,000 tax credit that $8,000 tax credit, what it did was it caused prices to artificially spike because you just moved everybody into that zone. They all tried to buy, prices went up, so they overpaid for homes. And then the day after it expired in April of 2010, who was going to buy a home without that tax credit? So home prices declined. And when home prices declined, those people who thought they were getting an $8,000 benefit were $15,000 underwater. This is not a good idea. You need to, as I've said before, you need to take this. Some ideas to take the same dollar. If you want to spend dollars, address the problem. Don't exacerbate the problem. The problem is a shortage of inventory. The only ones who are going to put the inventory up are builders. So perhaps go to a builder and say, hey, in your MSA, in your zip code, if you're willing to build a home below 75% of the median home price to really alleviate this problem, we'll help you and help you with the burden of regulation. We'll help you with the burden of the lumber costs, which are costing $25,000 on average more per home. Let's apply the dollars there and reward builders and incent builders to fill the void where it's needed and make this housing market healthier. But it doesn't seem that they're.
It's such a great idea, man. We talked about it on our show, and we actually leveraged your ideas. We need to give you credit for the ideas that you just kind of talked about again. And it's so obvious. Like, how do we get Barry into the government to make some of these decisions? I don't know if you, want that job, but man,
oh, I can't do that.
It's so obvious that you can't pour gas on a fire. You just outlined two amazing ideas that we tried to further as well that originated with you, which is, again, guys, why it's so important to subscribe to MBS Highway. Like, I don't have a free account. I pay to listen to Barry every day because I find so much value in it. And he's nice enough to spend time, 20 minutes with us today to talk us through all that's going on and to arm us with all this information to go take out to consumers and our realtors. It's so maddening because you laid out beautifully two amazing ideas that would actually address the problem. And again, old Ryan would have been hypercritical about the move, and I am still a little bit critical. But I do see the heart in the idea of let's help a family that's never owned a home, and define that by two of the parents that have never owned a home. That's pretty cool. Like, let's help people get into a home that their generation and the previous generations never owned that. I don't know how we talked about this in the green room. Kind of a fun. I don't know how you prove that. So that's a kind of a weird question, but I like the idea. It's just not going to help right now, and it's going to actually exacerbate the problem.
Ryan, the thing of it is, and the best analogy I have there is we all want to help. We sign us all up to try and help, but we don't want the cure to be worse than the disease.
Yeah, I just need to talk you into maybe making a run for because we need.
I would go crazy. I have no patience for that, bro.
You've done well, man, in your life. You don't need to work anymore. You're gonna go be a civil servant for us and help make some make sense decisions in housing for us.
Well, thanks, man. I appreciate it.
Yeah, we're all gonna write you in.
Oh, well, listen, I appreciate you and RC. You guys do just such a great job. Love your shows. Love the guests you have on. Love the heart you have and the insights you have, and all you folks that watch and all the kind comments and nice remarks that you make. They're so appreciated. God bless you all. I just wish everybody all good out there. And listen, this is going to be a good year. Do a lot more debt consolidation loans and help people. When you do your purchase, make sure that you're helping people evaluate those purchases. So this is not going to be a soft year. This will be a great year. Just you have to shift your focus a little bit and take advantage of what the defense is giving you.
Yeah, guys, Barry gave us the gold and exactly what you need to take out to the market right now. Take this. Use it. Barry, it's the biggest compliment you can give Barry and I is when you share the content and the knowledge that he has given us and give that to your marketplace. So please do that. Please share. Add your 2 cents to it because I know every market's a little bit different. But Barry, your time's uber valuable, and it's helped us navigate this market for many years. So thank you so much for spending it with us, man.
Thank you, brother. Good to be with you.
Yeah, we'll have you on again soon. Thanks again, Ari Source, Nason. We'll see you guys next week.